Welcome to the It's Your Smarter Money Show, where you will learn well to live well. Discover investing and financial planning strategies, ways to live your best life, insights from engaging experts, and much more. Now, please welcome your hosts.
Hello, I'm Dr. Laura, and with me is Professor Steve. Our objective today is to help you understand how to evaluate your portfolio, since most people really don't know how to do it. It's easy to focus on performance when you look at just your statement and you see that headline number, which a lot of people consider the scoreboard. But a lot of people misinterpret that information. First of all, they misinterpret it across multiple time periods. And also, they don't understand that it's important to understand how that return was earned. Was it a consistent ride? Was it a volatile journey? What exactly happened? And without that context, the performance is misleading.
Yeah, and also a lot of times they don't understand the importance of not just understanding return, but also understanding the risk associated with that return.
Precisely. So, and there are a lot of risks, right?
Yes.
Something is all about risks. And one of the main risks that we always focus on is volatility.
Yep.
But Steve, before we even talk about, the actual stats that we tend to look at, I think it's really important for us to just take a look at, how do we actually look at data as scientists? Scientists
Right.
to look at large batches of data, large pools of data, and they look at how it performs over time, and they call this a distribution. So the distribution of investments includes all the different observations of data. So when we look at 100 years of data, performance of the market, we plot it on an XY axis. And what we see is that it tends to follow, in a simplistic fashion, a normal distribution. I mean, Steve, we could get into the nuances.
Yeah, we're not going to do that.
Completely normal. But for our argument, for our discussion, the normal distribution, this is a very common distribution. It's used in the sciences. It's used in finance. Yep. And it basically says that based on the central
limit theorem,
that most of the observations occur in the middle, and then they start, some are on one side, some are on the other side, and they are becoming less and less as you get further away from that central go the observations occur. They never go away. Those tails, if you could notice on this distribution that we're showing you right now with the height, the peak, and then tailing off, you see that those tails never actually go away, which means that things can happen out there on those tails. For most of our observations, they're going to occur closer to that average mean. About the properties of a distribution curve. So the properties say that there's equal occurrences on the right side of this left side. So we're saying that the average over the past 100 years is 8.7%. And I want to make sure that people understand 8.7% is a real return, not a nominal return. So when you're looking at different types of data, you need to understand that over the past 100 years, it's been around 8% on a real return basis. The other properties of the distribution of a normal curve, which are so interesting, is that what they found scientifically over and over again, that the occurrence of, I have to introduce the concept of standard deviation. Within one standard deviation, either plus or minus, you're going to have 68.5% of the occurrences occur within one standard deviation.
That's
Two
right.
standard deviations, 95.4%. Three standard deviations, 99.7%. And if, Steve, we look at this 8.7%, and we say plus or minus, our standard deviation, which has been averaging at 15.8% over that period of time.
And While this is a very much an idealized version of the way things look from a probability standpoint, we know that the left tail tends to be more events occur in the left tail than one would expect.
Normal distribution of the market.
Yep.
However, if you're evaluating the performance of your overall investment portfolio, you need to make sure you understand, are you being completely exposed to this risk? Or is
Yes.
somebody helping you mitigate this risk and manage this risk? And we think that the only real job, we can't control what's happening in the market, but we can
No.
control the amount of risk that we expose you to. And so
Right.
we use a bunch of tools to help you evaluate how much risk is in your portfolio.
The Sharpe ratio is how much return are you getting above the Treasury bill rate in relation to how much risk you're taking, which we just identified as the standard deviation. And so this is just a nice metric to look at and say, am I getting a lot of return in relation to my risk, or are I getting very low return in relation to my risk?
It's basically telling you that how much return am I getting for each unit of risk that I'm taking. And so what's really nice about the Sharpe ratio that I like more than the standard deviation, for example, the standard deviation, when you look at it, it's like, okay, 15, what does that mean? The
Yep.
Sharpe ratio is when you have two different strategies or two different investments, whatever you're comparing, two different portfolios. If one Sharpe ratio is higher than the other, you know that it's actually more efficient. It's
Yep.
actually a better performance because you're getting a higher return for the level of risk that you're taking. You know what, Steve, I compare this to? So I like to use analogies. And I think about
Sure.
miles per hour with a car. So
Mm.
you could have a Toyota Prius, which might represent a higher Sharpe ratio because it has a higher miles per gallon. And you could have a Chevy Suburban, which is a lower Sharpe ratio.
It's important to understand, the less volatility you have, the greater the odds are that you'll actually accumulate more wealth. So this is really interesting. So small cap stocks, you think, gee, that's a great investment. And it can be through time, but it has an extreme amount of risk with a standard measured by the standard deviation, 31%. That means in any given year with roughly a 95% probability, you would actually lose probably about 40%. If you take 16% minus 2 times 31%, right? So it's about, what, 45% or so, roughly? You could lose in any one year. And so because of that, the Sharpe ratio it's lower than large cap stocks. But there's also a really interesting concept here that you have to look at not the average rate of return, but what you actually as an investor experience, which is the geometric or compound rate of return. And so what we did is we computed what the compound or geometric rate of return would be based on the average and the volatility. And so in effect, you're really only going to average about 10.4% a year, believe it or not. And so we say the difference between the average rate of return and the compound rate of return, that difference, we call it volatility or drag risk. And you can see large cap stocks, higher Sharpe ratio. Equity REITs have actually had a decent Sharpe ratio of 0.5. Intermediate government bonds are low, but mostly because of the return, which is low, not necessarily the risk. So, but you do see you have less risk drag there, believe it or not. So if the average rate of return is 5%, the geometric is 2.6 and the risk drag is 2.39, but it's still not really a great return. But people say, gee, the stock markets are averaged 11, 12% a year since 1926. The reality is you've really only increased your wealth by around 7.8 or 7.9% a year, which is quite a difference, right?
So, Steve, there are two things that I want to point out. First of all, when you see that under large cap, it's saying 12.3%, that is the nominal return. So if for those folks that are really paying attention and you saw 8.7% on the prior slide, we're talking about the same thing. We're just talking about one is in real term and the other is in nominal term. We sometimes use these types of things interchangeably. Because we are financial planners, we'll tend to want to know real term because we want to know what you have for the future. I'm sorry if that confuses people. I just wanted to point that out.
No, that's
a
great.
little messy. The second is that The geometric return takes the movement of returns over time. It is multiplicative, not an additive.
Right.
You need to account for the compounding effect, which is great on the way up, not so great on the way down. And when you have
Yes.
volatility, any volatility whatsoever, you'll always see that the geometric return is less than what you thought you were getting if you had just done simple arithmetic returns. So a lot of people will get average. It's wrong. It doesn't add up
Yep.
because there's been volatility in their portfolio. Geometric return, despite the fact that most people don't know what it is and it's not talked about, is the right way and the only way to look at returns. Pretend you just won $1 million from some kind of lottery, and you said, Laura and Steve have us invested in a nice conservative portfolio that's well thought out and very responsible. So I'm going to take this $1 million and I'm going to go for a big return. And so you put it on some kind of speculative stock. And in the first year, the $1 million goes up by 50%. And you now have 1,500,000. And you think, wow, this is fabulous. And then it goes down by another 50%. And you say, well, okay, no harm, no foul. Up 50%, down 50%. I have on average a 0% gain loss. So everything's fine because you added the plus and the minus, which we just told you was not the way to do it.
Yeah.
The reality is that you're actually down way below what you initially won. If we actually do the math on that, while the arithmetic mean was 0, you think you broke even. You didn't really break even because the geometric mean was a negative 13.4%.
Yes.
Sequence matters. Sequence of the returns. And now that you're down this much, you don't just need to make up 13.4% to get back to where you were. You need to make up 100% to get back to where you were.
That's right. Or if you want to go back to your original investment, to go up about 30%, 33% or so.
Even said,
Yep.
What part of the reason why you don't want to necessarily be in such a volatile portfolio is that, number one, you might not have the patience. You might be too anxious to sit through all of that and wind up selling at the low. But the second thing is for people that are actually taking cash distributions out of their portfolio. You don't
That's right.
taking cash out of your portfolio when it's down. You know, for somebody that has a really, really long horizon, 20, 30 years, fine. And you're okay with riding the roller coaster. But most people, it doesn't make sense.
No, and if you don't need to pull cash out of your portfolio, then you can ride it out. But sequence risk, which Laura brought up, is really affects you if you have to pull money out of your portfolio. The sequence risk and that combination together could be devastating for your retirement, quite honestly. So you got to reduce the volatility of your portfolio if you're pulling money out. So let's go to another concept, two concepts here, beta and alpha. We're going to show what this means graphically in a minute.
On beta first, because beta really is relevant to what we're still talking about.
Yep, it is. Yes. Yeah. And so beta measures the volatility of an investment in relation to the market as a whole. So if beta is 1, it means you have the same volatility as the market, roughly. If the beta is 0.5, you have roughly half the volatility of the market. And if beta is 1.5, you have roughly 50% more volatility than the market as a whole. Okay. And it's a metric you may see and you may wonder, what does that mean? Well, that's really very simply what it means. And we're going to show you, as I said,
to Sharpe ratio.
Yeah.
So Sharpe ratio is really, again, that comparing investments is really interesting. Standard deviation is another one, which is very interesting. By the way, standard deviation captures all the sources of volatility, while beta is really just focused on the market risk and market movements.
Very good point.
But beta is an interesting metric because it gives you a sense of, am I, kind of just tracking the market, or am I doing something different that is maybe more protective, or am I going even more risky than the market? So it can give you a sense of how risky you are against relative to something, the market.
Yeah. And also alpha, which we're going to show you graphically what that means in a minute, is saying, all right, did an investment generate more return than it should have in relation to the risk it's taking? So in other words, in particular with an active manager, were they able to add value? Were they able to exceed the threshold of their management fee and the amount of risk they're taking and actually perform better than the market? That's effectively what it means. And you're going to see that actually very few managers, active managers in the long run, can actually achieve that. But it's an important concept to understand.
Steve, can we talk about the just the difference between beta and alpha?
Oh, sure.
In an analogy, I was talking about cars, so let's just continue to talk about cars. Okay, so beta, really measuring the speed of vehicles relative to the flow of the market. So imagine that you have three cars. You have a Toyota Camry, which has a beta of 1. It's going to get the job done efficiently. It won't surprise you. It's not going to be, a slow car, but it's not going to be a fast car. Then you have a Porsche 911, let's say, and that's going to have a beta that's greater than 1. It's going to go much faster automatically relative to the Camry, or a car that maybe has a less than 1 beta, might be something like an Outback Subaru, where it's really intended to be just more of a comfortable, safe ride. That's the idea. Like, you're still on the same racetrack or the same road, but you have different vehicles. When you start talking about alpha, beta is the speed of the vehicle, where alpha is more a comparison of, okay, we now have 3 cars that we're all in the same car. We're in a Camry, a Toyota Camry, but one car actually goes faster than the other, not because they're in a faster car, but now because they're actually performing better. They understand the road better, they're making quicker turns, whatever it might be. So they're in the same vehicle, but they're just doing better. I hope
that's a good analogy, actually.
Okay, I was trying to think about how you explain. So this is, again, the teacher and me trying to think about how do you make this, because beta and alpha can get a little bit confusing.
The only thing I would change is Porsche 911 to supercharged Corvette, because I have one.
Okay, there you go. I should have the Corvette. So alpha is more about the driver's skill. We're all in the same Toyota, but one of the driver, it has a greater skill than the other.
So, and this kind of relates to that concept, but shows it graphically. Beta here would be the slope of that line. And you see that in a normal world, you would have more return if your beta is higher, because you'd be approaching the market return. And when beta is 1 there, you'd be around 11% or 12% range, which is the return of the market. But alpha can think of as a point above that line, saying, gee, somehow that manager or investment achieve more return than it should have in relation to its risk.
Beta is 1, and you actually perform at 12. You would have a positive alpha. That's right. Would mean you went faster. But notice that beta on the x-axis and return on the y-axis. Notice that you are compensated, in theory, for having a higher beta. So while beta is important, you want to possibly have a lower beta. You understand that you may be giving up some return.
And also the intercept here is actually the risk-free rate, which typically most people consider to be the 3-month treasury. And that would be the intercept, because effectively it's considered to be a riskless investment. So we've talked about alpha, and the question is, can managers really generate alpha? And so I got this information from Morningstar, and you can also get it from S&P has a website, and they track this as well. And what I just saw just recently backed up this data. And you may just say, well, gee, may not measure every potential effect or factor that should affect whether managers outperform the market. But it's a decent overall view. And you can see that over 10 years, for example, for large blend, only 10% of managers actually beat the benchmark, which is pretty poor. And you may see that over 1 year, maybe 43% will, but through time it declines. And by the time you get to 20 years, only 11% are actually beating their benchmark. Maybe in the long run, you're better off having an index fund, and we do that, and we'll talk about that a little bit more. But the other problem is, of the 43% that beat the market, well, you might have gotten lucky. It's in other words, a 1 out of 2 chance, roughly, that you're going to pick the winner. But in 3 years, it's a 1 out of 3 chance. 5 years, you got a 1 out of 4 chance, roughly. So it's almost like the odds of you picking the winner declines through time. So you may think you've picked a winner. Well, you might have gotten lucky, but you may not too.
And this is actually part of the argument for why passive investing makes a lot of sense. But one of the things that I want to point out here when you're looking at this is that these are the traditional asset classes. Really, we're just talking about the traditional domestic primarily market. There's a foreign large blend on the bottom, but everything else is just large, mid, small, domestic. And one of the things that you can see is that it looks like managers are a little bit more in control and able to evaluate value-based types of investing. Value, because they're actually going and looking at the fundamentals of the businesses. Are they producing cash flow? Are they producing profit? Are the price earnings ratios appropriate? And so there's some real measurements. When you're looking at large growth, for example, that's kind of speculative. You don't really know with these larger companies which ones are going to pan out. So it kind of talks right to our philosophy on why value investing makes a lot of sense. The other thing that I wanted to make clear, though, too, that I think is not necessarily obvious when you're looking at this, is that the managers that have positive 20-year performance were not necessarily the managers that had year 1 performance or year 3 performance. They're the ones that had a real strategy, disciplined strategy over a long period of time. And that's why, truthfully, most people get really, they might say, well, I'm going to fish in the pond where they are outperforming. Well, how are you going to evaluate that? Are you going to evaluate that based upon last year's performance? Because you probably are not going to select the right manager. It gets very difficult to understand that you're invested with a manager that underperformed last year, but in the long run is going to outperform because they have a real thought process and a real strategy. A lot behind these numbers.
There is, absolutely.
So this is just the traditional domestic investments that you have all the analysts pouring over and focused on and really are investing against each other so that they're coming up with a real efficient equilibrium. That's not necessarily what's happening in the non-traditional space at all. So all the answer asset classes that we have you in are more inefficient than these asset classes.
So we talked about the standard deviation and how symmetrical the concept is with respect to standard deviation. But investments don't really necessarily work that way. And you can see here the left tail. In other words, there's a greater incidence of negative events in the real world. And in our software, we actually use this type of curve rather than the theoretical standard deviation. And we optimize on that little orange area. We optimize to try to come up with combinations of investments to minimize those worst case events. Okay, and so that's how we do it. So it's a much more complex system than just using the regular normal distribution.
I have another analogy.
Yeah. Oh, please do.
Okay. So let's say this distribution. Let's pretend that you're in a spicy pepper challenge with your friends, and this distribution is all the different potential choices of picking a pepper from a bowl that is mild or hot. And so on the left-hand tail here is the probability that you're going to pick a really hot pepper. So you know that you're going to you have a 5% chance that you're going to pick a really hot pepper. But when you don't know, and that's value at risk. What is the chance that I'm going to pick a hot pepper? What you don't know is how bad this C bar, conditional value at risk. measures for you how bad it's going to be. Are you going to like
Yeah.
smoke coming out of your ears, or is it going to be acceptable? And that piece is really important. Steve, I think about, yeah, I always think about the long-term capital management situation in the 90s, which was a bunch of PhDs who won Nobel Prizes. And they did some really great work. They were quants, and they had models that were very sophisticated, and the strategies really appeared to be very, very sound. And everybody was loving long-term capital. This was around, I think, 98 it was. So they were heavily reliant on historical correlations and assumptions around market behavior and those types of things. But when what they didn't really look at, they didn't look at how spicy the pepper could get. They didn't look at that worst case scenario, and they were blindsided by that. If they had looked at CVAR, they would have been forced to consider how devastating, if in fact they hit one of those bad patches, how devastating it could be and how badly it could harm their business, because it was so devastating that it put their business out of business.
And almost brought down the market too. It led to a brief financial crisis also in 1998.
So if they had used CVAR, they would have been able to measure that. And so, you all know, as clients of ours, that we're always looking at best case, worst case. We want to know, worst case, can I live with that worst case? Will that worst case just completely destroy me, or is it something that I can live through? And so that's really what this measurement is looking at. And so it's really important.
And I always like to say that mathematics doesn't always fully capture the risk of something, because it can be an event that's just not even thought of, that was never captured in the past history, that was used to create the risk level for an investment. So you have to look at that too. And that's why I always say I'm so cautious about emerging markets, because I don't think the historical risk in a lot of emerging markets properly captures the real risks that are there.
The C-bar is way up there. The C-bar can be devastating. I mean,
that's right.
If you're willing to lose all of that piece of your portfolio, then fine. But I don't think most of our clients are willing to do that.
Nope.
If they are, they should do it on their own.
Yeah, exactly. So here's another thing you may have heard of called maximum drawdown. And so what it means is how much did an investment decline in value from its most recent peak, okay? And so in this case, we show as an example the S&P 500 and how much it was drawn down from, this is in 2022. And so it peaked around January of 2022. And at its lowest point, it was down about 25%. And so that's its most recent maximum drawdown. And now we could have run this back further. If you go back 20 years, you see higher maximum drawdowns, perhaps.
7 to 2000, April of 2009.
Exactly.
57%, something like that. Yeah.
That's exactly, And so we only showed us, we're not saying this is the worst maximum drawdown for the S&P. We only chose this just to help you understand what that means if you see that term, maximum drawdown.
And people need to understand whether they're willing to subject themselves to that, if they're okay with that. I know a lot of folks think that because what they saw in 2022, that we had an immediate recovery right following that.
Right.
So it really wasn't as painful. Don't be too fooled by that, because it doesn't always happen that way. Sometimes, we talked about the NASDAQ. It took 15 years to come back up. I mean, how long did Japan take? I don't even know.
Years.
Years. I want to say 20 years or so.
I think that's about right. And we also had that in this country too. People may not recall, if you're younger, from 1967 to roughly 1981, I think it was. They would always talk about the big goal was, can the Dow ever get above 1,000? The S&P wasn't as popular then as an index. And it didn't for years. And there were several really bad declines. I remember, I think from 72 to 74, the market was down about 50%. And I think there was another bad one in the late 70s, times of high inflation and, probably high growth in the money supply as well. There were a lot of things going on. And we also had a couple of supply shocks, the oil crises in 73 and also again in 1979. So there were a lot of things going on. But, diversified portfolios did do a lot better. So we talk about correlation, and it's something that you may hear is like, how does one investment perform in relation to another investment? And so if a correlation is one here, we show that, and it's called rho. Typically, you see the Greek term rho as the term that's the variable that's used for correlation. If it's one, it means they move in conjunction, exactly the same, their price movements. If it's -1, they move exactly opposite to each other. Okay. And if they're not correlated at all, you see that it's scattered all over this little chart on the bottom, rho equals 0, no correlation. There's no movement in relation to each other at all. So, and what you can look at in each of these charts, and the x-axis will be one investment, and the y-axis would be the other, and their price movements in relation to another.
And rho is just one of the statistical tools to measure correlations. It's probably one of the most common, Pearson rho. But there are a variety of other correlation tools that people use in the science. This is what we see most people use in the finance profession. And it's helpful. It's helpful, but we actually go a little further than that.
Yeah, there are some issues with it. And here's an issue. Here you go. Look at the first one here, the Pearson rho, the Pearson correlation is 0, but yet look, those investments do seem to be correlated in some complex way, right? Some kind of nonlinear relationship there. And even the second one, it's smiling at us there. The one on the left, we can't figure out what it is there. And the one on the bottom right, the correlation 0 again, but again, it seems to be some pattern here. And so there are issues with just using correlation, and we'll go over that a little bit more.
There's issues particularly because returns, while we use that normal distribution bell curve, and we assumed a linear kind of relationship on the data, it's not linear. And so that's why some of the more sophisticated non-parametric types of measurements make more sense.
And here we just show you what we call a correlation chart, and it shows the correlation numbers among some different types of investments. So these are actual investments, and actually you may actually hold some of these in your portfolio. So let's look at the second line, Cohen and Steers. And the way to read this is to look at, all right, what's its correlation with number one? Number one is this absolute convertible arbitrage fund, and it has a correlation of 0.5. And that's actually a good thing, because if you combine those in a portfolio together, if you have investments that aren't totally correlated with each other, it improves portfolio efficiency, because one is zigging a little bit while the other is zagging, and it smooths out the return of your portfolio as a whole. Now, we're not going to obviously get into the mathematics regarding how that works, but it can be relatively complex. But we do look at it, and we do choose asset classes and investments based on these metrics. So we look at these correlations. But we also, as Laura mentioned, look at a much more advanced, or I should say complex, version of correlations, which we'll talk about in a minute or two.
And
but you can see here, anything. Oh, go ahead, Laura.
No, I was just going to say, if you look at the very bottom row, which is what most people are used to looking at, which is the S&P 500, and you go across those numbers, the one number that might pop out to you is the fifth number, 0.28, which is the asset class that's the least correlated. I know that this is hard to read for some people.
Yeah, it is.
This number, if you go up in the top, ideally it would say one is absolute convertible, 2 is Cohen and Steers, but it doesn't. So 5, what is 5? Well, 5 is the reinsurance bonds. And so we know that the U.S. stock market is very the least correlated amongst these choices with reinsurance bonds. And that makes sense, right? Because the reinsurance bonds really have nothing to do with the market. They are based upon insurance premiums and natural disasters and those types of things. So
Yeah, and it's one of the reasons why we have it, because it really improves portfolio efficiency, and it's had a really decent return over the last 5 years on average.
yeah.
So one of the problems of correlation we showed you in a prior kind of silly charts is that correlations are not necessarily stable, and they do change through time. And you can also say, well, something's really correlated based on the last 5 years, but well, guess what? No, over the last 3 years, it's not correlated. And this is a great example. It shows you the correlation between the S&P 500 and the Morgan Stanley. It's Morgan Stanley Europe, Asia, and the Far East Index, which is our international investments. And you can see it really dropped. They were highly correlated. And in fact, we only go back about 3 years here. But even before that, they were highly correlated for years. And you might say, well, gee, why would I even have an international? Well, guess what? Sometime beginning, about a year ago, the correlations changed and they became much less correlated. And we've seen that this year because international actually has dramatically outperformed domestic.
Right.
And so that's one of the...
Right? Because when we think about why correlations shift over time, globalization and interconnected markets are a big shift that occurs, and it seems like there's things happening there. Economic cycles are another reason. Market sentiment, risk
valuations,
monetary policy, interest rates,
currency, exchange rates,
right? Inflation, geopolitical things like and so forth. So that causes a lot of shifting, and so we almost would say like this is a change in regime.
Yes. And so that's another issue of correlations. So we use something much more advanced, which I'm not going to get into, talking about in great detail. But we use something called a copula, and it actually takes into account the fact that correlations change, and it models it in a much more complex way mathematically. And so this would just be like a three-dimensional view of a copula, because a copula is not really a two-dimensional construct like correlation is. It could be a three-dimensional construct, as you see here. So it's really complex. And just to let you know, we use in our software much, much more complex constructs, which we think leads to more, I would say, durable and portfolios that hold up better in the long run.
Particularly, it takes into account the extreme events like market crash.
Yeah,
which is
that's a great point. Yeah. Yes, they're factored into a copula, where they may not necessarily be factored properly into a correlation, especially if you're not looking at the entire history. And by the way, some asset classes don't have a lot of history; they only have 20 or 30 years, and so you come to the question: is that history really a perfect example of what it really should be, or have we just taken a small sample out of something that really may not really look like that in the long run? So we just don't know. So this is something we look at too. We look at something called downside capture. So in other words, for example, we go down to number 2 there on the table. You see the Invesco S&P Revenue Shares ETF, which we own. It's only been capturing about 82% of the downside of the market, which we like that. It means it has less volatility on the downside than the market does as a whole. And you can also see the S&P 500 dividend ETF is about 78%, again, less downside capture. And also a pace of U.S. cash cows, again, less downside capture there too. And that's because these are value strategies, and value strategies tend to capture less on the downside.
Right. The one that has in a higher downside capture is the Russell 3000 index.
Yes.
It has a slightly more downside. So that means that if the market goes down by 10%, the Vanguard Russell 3000 will go down even more, maybe like 10.5% or something.
And in part, it's because it has small stocks in it too. So.
Right. And there, you notice that there on this x-axis is showing downside capture. On the y-axis, it is showing upside capture. If you plugged in some of our other investments, you would see some more upside capture, which is fine. But for the purposes of managing and monitoring risk and understanding risk, we really want to understand what our downside capture is.
Another important concept is to understand how do you actually calculate return on
Right, so this is
a
a different concept, right? So we talked about
Yes, yes.
and how to monitor risk. But when you're looking at the performance of your portfolio, how do you understand the performance of your portfolio over
Yep.
time? And I just want to take away so when we're looking at more of a geometric return, both of these measurements are multiplicative returns, this IRR and this time weighted return.
Right.
So we're in the world of how should you actually look at performance? You should look at it in terms of the compounding effect. But then
correct.
there's these two metrics that you could choose.
Yes. And internal rate of return and time-weighted rate of return actually equal each other if there have been no cash flows in or out of a portfolio. So the problem arises if you've added money to your portfolio, taken money out of your portfolio, then these numbers do not match. And that's a big problem. In our reporting, we always use time-weighted rate of return, which is a much more realistic and accurate measure of measuring return. And by the way, there's a great academic article I read that say a lot of the endowment funds and pension funds are not really using time-weighted rate of return. They're using internal rate of return, so they're not necessarily measuring return properly. By the way, which is interesting. So this is a perfect example of why you can't use internal rate of return if you're moving money around. So if you invest $100 and your total return, for example, is you down for that period of time is minus 10%. Okay, and so you actually now are down to $90, but you added $50 right at that period, at the end of that period, to your portfolio. So now at the end of let's say a year, you're at 150. So you say, gee, my return, if you just look at internal rate of return and not take into account the fact you added money to the account, was gee, I'm at 150 now and I invested 100. Wow, I made 50% of my money. Okay. But that's a problem. What happens is in the first period, you were down 10%, but after you added the $50, you went from 140, which is the value of $90 plus the 50 you added, back up to 150. So your real return was the combination of the first period, which is minus 10, and the second period where you're up 7. Okay. So the reality was your real return was minus 1.8%. And so what you need to do is you actually need to create intervals around time periods in which you either added or took away money out of the portfolio to calculate the true return. So maybe, Laura, if you want to, I don't know if you have an analogy for this one.
I do have an analogy.
Oh, perfect. Good. I'm glad.
Well, so, sticking with the car theme, I guess, IRR is really more about your own personal road trip. As you're going down, you're traveling somewhere, if you add or remove passengers, add or remove money, you're making those choices of, you're making stops and starts and, who paid for gas and what's going on with your overall personal trip. But it's really more about, so if you're putting money in dollar cost averaging perhaps into your portfolio, or you're taking money out for distributions, those are the decisions that you're making based upon your personal trip.
Perfect.
Whereas the time-weighted return is about the road's performance, the actual investment performance, not your personal experience. So it tells you how smooth or bumpy the road has been, regardless of who's joined your car or not joined your car or any of those types of things. Does that help?
Yes, it does. And time weighted is the real way to show what return really is. But as I mentioned earlier,
it's the way to show it in terms of how our performance, because we're not making choices of putting money in or taking money out. If somebody wanted to see it based upon their choices in terms of adding money in and out, then it would be IRR. So they have different.
That's correct. Yeah, good analogy.
We believe that strategic investing is about not just chasing returns. It's about building a portfolio that performs well across many different market conditions. And, key to that is understanding correlation, understanding the volatility in your portfolio, understanding the amount of risk that you're taking, regardless of what happens. So
Yes.
there's one little, and I don't know if I'm going to do it justice. One little thing that I heard once, if you're a young family and you're in your 30s, let's say, and you have a bunch of kids, and you go out and buy a life insurance policy, and now you're 60 and you realize that that life insurance policy was not used because you're still alive and well, and your kids are now grown up and there's no exposure anymore. Did you make the right decision to buy that life insurance policy? Was that a mistake or was that right? We would argue it absolutely was the right decision,
Yes.
regardless of where you ended up, because we did not know. We did not have a crystal ball to know that you are going to be okay. And that's essentially how we approach investing. Is we're here to protect you from yourself sometimes.
Yes. Against the certainty of uncertainty.
Right. And so that's why understanding how you received the performance that you received, not just that you received that performance, but with what level of risk did you expose yourself to, is so really important. And
That's
clearly
right.
we love to talk about this. So if you have
Yeah.
any questions you want to understand in any more level of detail, Steve's even happy to break out the software and show you how things work.
Yeah.
If you really want to see it, we don't want to bore anybody that doesn't want
No.
to see it. But if you want to see it, please let us know.
Yep.
So as always, we're happy to help. We're here to help. So until next time.
Thanks for listening to the It's Your Smarter Money Show. If you found this episode valuable, please like and subscribe to our channel. Until next time, learn well, live well, since, after all, it's your smarter money. Thanks for tuning in, and we'll catch you in the next episode.